Welcome back to the deep dive. I'm your guide. And today, let's unpack this Markel Group Shareholder Letter from 1998. We're going back a bit.
Yeah, it's a fascinating one.
Our mission here is to really pull out the key insights, get a handle on their philosophy, and see how they actually navigated what was a pretty pivotal year.
Definitely pivotal.
Because 1998, it wasn't just any year. It was this mix of huge promise, but also some serious peril, especially in the insurance world.
Mm-hmm.
And this letter, it's like a unique window into how one company decided, okay, this is how we're going to operate and, thrive by sticking to their guns.
And what's fascinating here, right off the bat, is that contrast.
Yeah.
You had the wider market story in 98, the very start of the dot-com boom.
Right, that whole frenzy was just getting going.
Exactly. Huge growth, tons of speculation.
Yeah.
And then you have Markel with this incredibly disciplined, almost you could say contrarian approach.
It really stands out.
Yeah. And this letter, it's more than just, financials. It's basically a statement of principles. It tells you so much about their long-term game plan and what really mattered to them, even when the market was screaming something else.
That conviction, it does feel like a time capsule. So let's set the scene a bit more. What was the general vibe like economically, financially back in 98? Was it all smooth sailing?
Definitely not smooth sailing.
Yeah, the sources paint a picture of, global instability. We're talking big problems in Russia, Brazil.
Yeah. And those hedge fund failures were making headlines.
Yeah.
Remember the long-term capital management? That was 98.
Exactly. And the Asian financial crisis was still casting a shadow, so not exactly a calm sea. It was a time of pretty intense market volatility, lots of uncertainty floating around.
Mm-hmm.
And then you zoom into the property and casualty insurance industry specifically. Well, it was facing its own major headwinds.
Oh, yeah.
The letter calls it extremely competitive. It notes premium growth slow and, critically, returns from operations unacceptably low.
Unacceptably low. That's strong language for a shareholder letter.
It is, and get this. Over 3,000 companies were apparently duking it out, which was just driving prices down.
Wow, 3,000. That's crowded.
Seriously crowded. And adding to the worry, lots of observers felt that loss reserves were inadequate. Which, for anyone listening, that's a huge deal in insurance. It means companies might not have enough put aside to pay future claims.
That's a ticking time bomb, potentially. It hints at possible financial weakness down the road.
So how did this whole messy environment shape what Markel did?
Well, if we connect this to the bigger picture, you see how Markel's choices were quite deliberate. Many other insurers, faced with those poor operating results, were kind of leaning heavily on their investment portfolios.
Letting the rising market bail them out.
Pretty much. Relying on those rising investment portfolio values, declining interest rates, the booming stock market, basically, to paper over the cracks in their actual insurance business.
Okay.
And the letter also sort of hints at others manufacturing earnings via creative reinsurance arrangements.
Creative accounting, basically.
It suggests maybe less transparency, perhaps some questionable moves that Markel clearly steered clear of, which really makes you ask, right? In a market that's pushing for quick wins, short-term thinking, how did Markel actually manage to stick to its principles?
And they really did stick to them.
Yeah.
Let's dig into Markel's actual numbers for 98 because they really tell that story of discipline.
Yeah, the numbers are key here.
So gross written premiums, they went up, but only slightly, 3% to $437 million. Net earned premiums were basically flat at $333 million.
Modest growth then in that environment.
Very modest. But here's the kicker. In that tough market, their underwriting profit exceeded $5 million. And they got a combined ratio of 98%.
98%, that's impressive. Especially then.
It really is. So just to explain for listeners, 98% means for every dollar in premiums they took in, they paid out 98 cents in claims and costs. They made 2 cents profit just from writing insurance.
Which many others weren't doing.
Exactly. It was better than the year before, and the letter says they were fighting tooth and nail for that profitable business. It wasn't easy.
No doubt.
Okay, shifting to investments. Their portfolio was big, $1.5 billion, up 5% from 97.
So growing steadily.
Yeah, and their investment returns were called excellent. They got a total equivalent return of 8.9% on the whole portfolio.
Very solid.
Now compare that, the S&P 500 index shot up over 20% that year for the 4th year running. Markel's equity part of the portfolio returned a very respectable 13.3%.
13.3%. But, and this is crucial, how they got it matters, right?
Totally. We'll get to that. But maybe the most important number for Markel, the one they always hammer home, is book value growth. It jumped 18% to $77.02 per share.
18% growth in book value. That's strong.
It is. They actually had this ambitious goal of compounding book value at 20% a year, so they just missed it, but still, 18% is powerful.
Racially consistently.
Right. And earnings per share were $10.17, comprehensive income $12.07 per share. So solid performance all around, driven by that discipline.
You know, what's fascinating here is how these numbers aren't just numbers. They're like physical evidence of Markel's whole philosophy.
How so?
Well, that 98% combined ratio achieved when things were so cutthroat, that's a proof of serious underwriting discipline. It shows they were willing to say no to bad business, prioritizing profit over just, getting bigger.
Yeah, avoiding that trap.
And the focus on book value growth is the main goal, not just hitting quarterly earnings targets. That screams long-term thinking, alignment with shareholders who are in it for the long haul. And if you link it all up, that 13.3% equity return, good, but not S&P 500 level, and achieved deliberately without owning any high technology or internet stocks.
Which were the absolute darlings of '98.
Exactly. It shows a conservative, quality-first investment approach. They weren't chasing the hype. They were sticking to what they understood. Makes you wonder what their peers thought of that restraint back then. Strength or weakness.
I bet it made them stand out. And that focus on a solid foundation, it definitely carried over into their strategy. So how did they actually execute their plan in that, hyper-competitive field?
Well, they kept hammering that theme of underwriting discipline.
Right. They even admitted it meant premium growth modest over the past few years. They owned that choice.
It wasn't an accident. It was strategy. They deliberately chose quality over quantity.
And the letter shows they were still wrestling with some older issues, like the costs from asbestos and environmental claims. They were having to carefully reallocate reserves between business units to make sure they were covered.
That's responsible reserving, dealing with the past.
And they were surprisingly open about past struggles, too, mentioning underwriting profit shortfalls in past 4 years because of things like high operating costs, lack of management focus, and inadequate loss reserves.
So, acknowledging weaknesses.
But crucially, they also talked about the steps they were taking to fix those problems. They weren't just listing issues, they were showing action.
Proactive. Good.
Then came a really big move that year, the acquisition of Griffin Holdings, Inc. The letter calls it one of the most important events of the year.
Okay, Griffin, what was the deal there?
The price was about $150.7 million, and Griffin owned 3 insurance companies. Let me see. International Insurance Company, Calvert Insurance, and First Reinsurance of Hartford.
So a significant addition.
Yeah, these companies controlled around $200 million in annual premiums. What Markel liked were Griffin's excellent franchises in specific niches like property earthquake risk and liability insurance for architects and engineers.
Specialist areas. Fits the Markel niche approach.
Exactly. But they were also really upfront about the challenges. They said Griffin had too much overhead and too much bureaucracy.
Refreshingly honest.
Right. No sugarcoating the integration work ahead.
You know, what's really striking about buying Griffin is the why. It wasn't just about getting bigger, which, as you said, was a trap many fell into then.
So what was the logic?
Markel explicitly saw it as getting additional investment leverage. It was a strategic piece to help them get closer to that goal of compounding book value at 20% a year.
Connecting the acquisition directly to the core financial goal.
Precisely. They estimated Group would add about $100 million in premium and, importantly, $300 million in incremental investment portfolio. So, more capital to work with, manage the Markel way.
It shows a very selective, calculated approach to M&A. It had to fit the model.
Totally. Which raises that interesting question, how does a company pull off a big, somewhat aggressive move like an acquisition while staying so fundamentally conservative in its core underwriting and reserving?
That's a great point. It must require a really strong, unified vision internally.
Yeah, it speaks volumes about their culture.
Which leads us nicely into their investing philosophy. It was pretty unique, especially given the whole dot-com craze happening in '98. How do they handle their capital?
Well, the letter really emphasizes their long-standing practice of careful selection and extremely low portfolio turnover.
So buy and hold good businesses.
Essentially, yeah. It was all about owning good companies for the long term to get the maximum total after-tax return, not about timing the market or chasing fads.
And they were crystal clear about the fads they weren't chasing.
Oh, absolutely. They stated it flat out. We currently own no high technology or internet stocks. And then they added, almost cheekily, the valuations of which we also don't understand.
Huh. That's a bold statement to make in 1998. Takes guts.
It really does. Sticking to your circle of competence when everyone else seems to be getting rich quick elsewhere.
So, besides equities, what else was in the portfolio?
They mentioned about $400 million in high-quality fixed income securities with fairly short durations. So bonds, basically, for stability.
Got it. Conservative on the fixed income side, too.
Yep. And they even detailed this model for profit they used internally. It basically laid out how underwriting, profit, after-tax earnings, and equity gains needed to work together to hit that 20% book value compounding target.
Like a formula for value creation.
Kind of, yeah. A very holistic view. And finally, they talked about their investment leverage. Remember, $1.5 billion in investments against about $425 million in equity.
Right, the $3.50 in investments for every $1 in equity.
Exactly. That leverage magnifies returns, both good and bad, which is why that underwriting discipline we keep talking about was so absolutely critical. You could only use leverage safely if the underlying business is sound.
Makes sense. The whole system had to work together.
And the consistency is just remarkable. In an era just dripping with speculation, Markel didn't just say what they didn't own, they explained why. That's a huge lesson,
Yeah.
sticking to what you understand.
It really is a core tenet of value investing right there.
Absolutely. And their whole approach, growing book value through disciplined underwriting and patient quality investing, is just a textbook example of sound long-term capital allocation.
It implies a really strong, unified culture must have permeated the whole company.
No doubt. Which leads you to think, how does that long-term patient philosophy actually play out day to day when your insurance folks are out there competing on price every single day?
Yeah.
How do you keep everyone aligned?
That internal alignment, that culture, it feels like the glue holding it all together. So looking beyond 98, what did this letter suggest about Markel's culture and where they saw themselves heading?
Well, the leadership was clear. The goal was building shareholder value. And they defined that through several key things: customer service, quality products, underwriting profits, and superior investment returns.
A complete package.
Right, not just one thing. And they pointed out how much they'd grown since going public back in 1986, saying they were at least 10 times larger by many metrics.
So proving the model worked over time.
Exactly. And they weren't naive about the industry. They saw the consolidation happening, lots of larger companies acquired or substantially reorganized. They expected more of that.
But they saw it as an opportunity.
Yes. The letter says, all of these developments spell opportunity for Markel. They felt their approach gave them an edge.
And what was that edge, according to them?
Their long-term competitive edge, they believed, was basically sticking with and communicating the important common sense principles which guided us in the past, especially as they brought new people in, like from the Griffin acquisition.
So culture is strategy. Keep the core principles strong. Integrate new people into that way of thinking.
Precisely. It was about preserving that identity.
You know, looking back, it's fascinating how their actions and words in 98 weren't just about getting through a tough year. They were clearly consciously building for the long run, building that compounding machine, as you called it earlier.
Yeah, they were laying bricks for the future, not just patching holes in the walls.
And thinking more broadly, their whole approach really makes you question how companies truly create lasting value. It's obviously more than just hitting quarterly numbers or following the latest market trends.
Absolutely. It forces you to think longer term. Which makes you wonder, in an industry like insurance, facing all that competition and pressure, just how vital is having that clear, well-communicated culture, those core principles? How much does that matter for attracting the right people, keeping them, and ultimately achieving that kind of success that lasts?
That seems like the million-dollar question. So wrapping this up, what does this all mean for you, listening in? What are the big takeaways from digging into Markel's 1998 letter?
Well, we saw that relentless commitment to underwriting discipline, right?
Yeah.
Even if it meant slower growth sometimes.
Yeah, profitability first. Then that patient value-based investment style, bravely ignoring the dot-com mania because they didn't understand it.
Sticking to their knitting. And overarching everything was that laser focus on long-term book value growth, pursuing that goal steadily, consistently, through all the market noise and industry churn.
The big lesson really feels like the power of having well-thought-out principles and just sticking to them year in, year out, regardless of what everyone else is doing.
It really does. Which leaves us with a final thought to chew on. Thinking about today's financial world, which, let's be honest, often feels dominated by short-term thinking, the chase for the next quick win,
For sure.
what timeless wisdom can we genuinely take from Markel's incredibly steadfast, almost stubborn approach back in 1998? How could that kind of deliberate long-view thinking maybe inform our own choices, whether we're investors or leading a business, aiming for that sustainable compounding success? It's not just what they did, but the deep why behind it and the kind of foresight needed to truly stand apart from the crowd.